2 years ago, Palantir was the most exciting stock on Wall Street. Institutional investors were piling in. Retail investors were calling it the next Google. The AI thesis was compelling. The growth numbers were real. And then, without a single thing changing about the business, the stock dropped nearly 40%. No missed earnings, no scandal, no competitor. The CEO did not resign. One number moved by 2 percentage points. And that was enough to reprice everything. That number is called the discount rate. In the last video, we showed you why Kevin Warsh becoming Fed chair means that number is almost certainly going up. Today, we are going to show you exactly what that means for your portfolio. In real numbers, with real math, no approximations. By the end of this video, you will be able to look at any stock you own and calculate whether it is now overpriced, fairly priced, or actually more valuable in a higher rate world. But first, I need to show you something that will make this feel very real, very fast. Here is the most important thing to understand about how stocks are valued. A stock is not a piece of paper. It is not a ticker symbol. It is not a chart. A stock is a claim on the future cash flows of a business. Every single dollar that business will ever generate, that is what you are buying when you buy a share. But here is the problem. Those cash flows do not all arrive today. Some arrive next year, some in 5 years, some in 15. And a dollar arriving in 15 years is worth much less than a dollar arriving today. The question is, exactly how much less? That is what the discount rate answers. It is the rate at which you shrink those future dollars back to today's value. Think of it as gravity. The higher the discount rate, the heavier gravity is, the faster those future cash flows shrink. And here is where it gets critical. Different companies have their cash flows arriving at very different points in time. Take Palantir. Palantir is a genuinely impressive business. Real revenue, real government contracts, real AI products. But here is the thing about Palantir that most retail investors do not understand. Most of Palantir's modeled value, the value that justifies its current price, does not arrive until year 8, year 10, year 12. The analysts who price Palantir are essentially saying, "Trust us, the cash is coming, just not yet." Now take Caterpillar. Caterpillar builds the physical equipment that runs the world. Bulldozers, mining equipment, construction machinery. Caterpillar does not ask you to wait until 2035. It generates real cash this quarter, next quarter, every quarter. 70% of Caterpillar's value arrives in the next 5 years. Same stock market, completely different relationship with time. And that difference, that timing difference, is everything when the discount rate moves. The formula is called discounted cash flow, DCF. Wall Street runs this calculation on every company on Earth. Analysts run it at Goldman Sachs. They run it at Bridgewater. Warren Buffett has called it, and I am paraphrasing, the only correct way to value a business. And in about 3 minutes, you are going to understand it completely. Here is the equation. Do not panic. We are going to build it, one piece at a time. The numerator, the top of the fraction, is the cash flow. How much money does the business actually generate year by year? The denominator, the bottom, is where the discount rate lives. And here is the critical insight. The further out the cash flow is, the more times the discount rate compounds. Year 1 is divided by 1 plus R once. Year 10 is divided by 1 plus R 10 times over. Which means Distant cash flows are crushed exponentially harder when the rate rises. Now here is the part that most people do not realize. For most growth companies, 60 to 80% of their total calculated value lives in something called terminal value. Terminal value is all the cash flows beyond year 10, everything the business will ever earn in perpetuity, compressed into a single number at the end. And that number is the most sensitive thing in the entire model to the discount rate. For Palantir specifically, analysts estimate that between 60 and 75% of its present value is terminal value, which means 60 to 75% of what you are paying for today has not happened yet. And the discount rate is about to make that future worth a lot less. Here is where most finance videos lose you. They explain the concept and stop. We are not doing that. We are going to run the actual numbers on Palantir and Caterpillar right now, side by side, and I'm going to show you exactly what a 2% rate change does to each stock in dollars and percentages. In the low-rate world, the world we just left, Palantir trades at around 20 times revenue. The market is using a discount rate of roughly 8%. At 8%, Palantir's distant cash flows, arriving in year 10, 11, 12, still have significant present value. The model says the price makes sense. Now, same business. Not one thing about Palantir's operations has changed. Same products, same team, same customers, same growth trajectory. But wash arrives. The discount rate moves from 8% to 10%, just 2 percentage points. Run the DCF again. Now run the same calculation on Caterpillar. Same rate change, 8 to 10%. Caterpillar earns most of its cash in the next 5 years. The discount rate hits it, but it does not hit it nearly as hard, because most of those cash flows are close to the present. The compounding damage is minimal. Let me say that again in plain English. Same rate change, same 2 percentage points. Palantir, down 38%. Caterpillar, down 7%. Not because anything changed about either business, but because of when their cash flows arrive. This is not theory. This is not opinion. This is the exact mechanism that played out in the market when rates started moving. Caterpillar is up 32% this year. Palantir peaked and pulled back sharply. The math predicted it. So what do you actually do with this? 3 questions. Run them on every major position you hold. Question 1. Where does this company's value live in the next 5 years or beyond year 10? Pull up any stock you own right now. If the analyst consensus requires the business to generate most of its value after 2030 to justify today's price, you are holding a Palantir. You are rate sensitive whether you know it or not. If the business generates real cash today, you are holding a Caterpillar. You are largely protected. Question 2. What discount rate is already baked into the current price? This is called the implied discount rate. You can reverse engineer it. Take the current stock price, plug in reasonable cash flow estimates, solve for R. If the current price only makes sense at a 6% discount rate and rates are moving toward 10, the stock has nowhere to go but down, even if the business is exceptional. Question 3, and this is the one that changes how you invest permanently. Is this business actually better in a higher rate world? Because here is what the market is missing. Some businesses thrive when capital is expensive. When rates are high, their competitors cannot afford to expand. The businesses that were always profitable keep compounding. The businesses that were borrowing their way to growth disappear. Caterpillar does not borrow its way to growth, neither does JP Morgan, neither does Exxon. Ask yourself, if cheap money disappeared tomorrow, would this business get stronger or weaker? If the answer is stronger, you probably own something worth holding through whatever comes next. Here is the one sentence that summarizes everything we covered today. If you cannot explain in one sentence when this business earns its money, you do not understand the valuation. That is it. Not the product, not the CEO, not the growth rate. When does this business earn its money? Palantir earns it in 2032. Caterpillar earns it this quarter. Same stock market, completely different risk profile when rates move. Write that question down. Apply it to every position you own this week. It will take you 10 minutes and it will change how you think about your portfolio permanently. Here is what I want you to take from this. The discount rate is not an abstract concept that lives in a spreadsheet at Goldman Sachs. It is a force that moves through your portfolio silently, invisibly, every time monetary policy shifts. The investors who understand this, who can look at a business and intuitively sense where the value lives, those investors are not smarter. They are not luckier. They are just doing the math that everyone else is too lazy to learn. There is an investor, almost no one in the general public knows his name, who built an entire philosophy around exactly this idea. That the business which earns its money close to the present, that shares its advantages with its customers, that is structurally impossible to compete with. That business is immune to almost anything the Fed can do. His fund returned 921% over 13 years, and then he walked away. That story and that framework is the next video. One question before you go. Drop your ticker in the comments below. Just the ticker, nothing else. Palantir or Caterpillar? Rate sensitive or rate resistant? I will tell you which category it falls into. If this framework changed how you think about valuation, subscribing takes 2 seconds. The next video is the most interesting investor story I have ever told. I will see you there.